In this video, we will walk through the essential basics of value-added tax, or VAT, in Denmark, so that whether you are running a business, considering an expansion into the Danish market, or simply trying to understand your obligations as a consumer or entrepreneur, you have a clear and practical overview of how the system works. Denmark operates with a relatively straightforward VAT framework compared to many other jurisdictions, but it is also strict and highly digitized, which means that getting the fundamentals right from the start is critical. At the highest level, VAT in Denmark is a consumption tax applied to most goods and services at each stage of the supply chain, from production to the final consumer. The standard VAT rate is 25%, one of the highest in the European Union, and there are no reduced rates as you might see in other EU countries. Instead, Denmark relies on a combination of a single standard rate and specifically defined exemptions to shape the VAT landscape. For most businesses, the key question is whether they are required to register for VAT. In Denmark, VAT registration is generally mandatory when you carry out economic activities on a regular basis and your taxable turnover exceeds a certain threshold over a 12-month period. This threshold is relatively low by international standards, so even small and medium-sized enterprises will often find themselves in scope. Foreign businesses selling goods or certain services into Denmark may also need to register, depending on their activities and whether they are using distance selling or digital platforms. Once registered, you will obtain a Danish CVR number, which functions as your business identification, and for VAT-registered entities, this is also used as your VAT number. From there, VAT becomes a core part of how you invoice, account, and report. When you issue invoices for taxable supplies, you must charge 25% VAT on top of the net price, unless a specific exemption applies. Invoices need to include certain mandatory information, such as your business name, address, CVR number, the customer's details, the date, a clear description of the goods or services, the net amount, the VAT amount, and the total gross amount. Denmark is strongly oriented toward electronic invoicing and digital bookkeeping, particularly if you are doing business with public sector entities, so aligning your systems and processes to support compliant e-invoicing is essential. On the input side, one of the primary benefits of VAT registration is the ability to deduct input VAT on purchases made for business purposes. If you buy goods or services with Danish VAT included, and these are directly related to your taxable business activities, you are typically entitled to offset that input VAT against the VAT you collect from your customers. The result is that VAT should, in principle, not be a cost to the business, but rather a tax borne by the final consumer. However, there are important limitations. Certain types of expenses, such as entertainment, some forms of catering, and mixed-use items that serve both private and business purposes, may have restricted or no deductibility. Where there is a combination of taxable and exempt activities, businesses may need to apply a pro rata method to determine how much input VAT can be deducted, which requires a sound understanding of their revenue mix and careful documentation. Exemptions are another key feature of the Danish VAT system. While there is only one standard rate, some sectors and transactions are simply outside the scope of VAT or are exempt without credit. Common exemptions include many financial services, certain insurance products, most healthcare services, education in specific forms, and certain cultural and sports activities. For these, you do not charge VAT on your invoices, but you also typically lose the right to deduct input VAT related to those exempt activities. This has strategic implications. Businesses operating in or around exempt sectors need to think carefully about their cost structures, contractual arrangements, and pricing, because VAT can effectively become an additional cost embedded in their operations rather than a pass-through item. In terms of compliance, Danish VAT is administered by the Danish Tax Agency, and reporting is largely digital. VAT returns are submitted periodically, most often quarterly or monthly depending on your turnover and profile, with smaller businesses sometimes allowed longer reporting periods. In your VAT return, you declare the total taxable sales, the VAT collected, and the input VAT you are entitled to deduct. The difference determines how much you pay to or reclaim from the authorities. Timely and accurate submissions are crucial, as late filings or payments can result in interest and penalties. Denmark's tax administration places significant emphasis on data integrity and real-time insight, which means that inconsistencies between your VAT returns, your bookkeeping, and third-party information can trigger questions or audits. As a result, robust internal controls, reliable accounting systems, and clear documentation trails are not simply good practice. They are essential risk management tools. For international businesses, it is also important to understand how Danish VAT interacts with EU cross-border rules. Intra-EU business-to-business supplies of goods are typically zero-rated in Denmark when specific conditions are met, including valid VAT numbers on both sides and proof that the goods have moved from Denmark to another EU member state. In these cases, the customer usually accounts for VAT in their own country under the reverse charge mechanism. For cross-border services, the place of supply rules determine where VAT is due, and in many business-to-business scenarios, the customer in another EU country self-accounts for VAT instead of the Danish supplier charging Danish VAT. Digital services and e-commerce to consumers involve additional regimes, such as the EU one-stop shop, which can simplify compliance but also require careful setup and monitoring. From a practical standpoint, if you are planning to operate in Denmark, it is wise to embed VAT considerations into your business model and processes from day one. This means aligning your pricing, contracts, IT systems, and staffing with the VAT rules that apply to your sector. For example, ensuring your ERP or accounting software can handle Danish VAT codes correctly, that your teams understand when to apply exemptions, and that your cash flow planning takes into account the timing of VAT payments and potential refunds. Many businesses also find it helpful to conduct a periodic VAT health check, reviewing sample invoices, contracts, and returns to identify and correct any recurring errors before they attract regulatory attention. To close, VAT in Denmark is characterized by a high standard rate, a relatively simple structure on the surface, and a strong emphasis on digital, rules-based compliance. Understanding your registration obligations, how to invoice and reclaim VAT properly, where exemptions apply, and how cross-border rules may affect your transactions will significantly reduce your risk and help you manage costs effectively. If you are considering establishing or expanding operations in Denmark, taking the time to build a solid VAT foundation will pay dividends, enabling you to operate confidently in one of Europe's most transparent and efficient tax environments.